The asset allocation. Mistake. Why most portfolios are built wrong. Most investors spend their time picking investments, which ETF, which stock, which sector. They research, compare, debate, and while they're doing that, they're ignoring the decision that research consistently shows has the largest impact on long-term returns: how they divide their money between asset classes. Asset allocation, the split between stocks, bonds, cash, and other assets, explains roughly 90% of a portfolio's long-term performance variability. Everything else is noise. What asset allocation actually is. Asset allocation is the decision about how much of your portfolio goes into each major category of investment. Equities, stocks, and index funds offer the highest long-term returns but with significant short-term volatility. Bonds, government and corporate debt, offer lower returns but more stability and income. Cash and equivalents offer safety and liquidity but minimal return. Alternative assets, real estate, commodities, gold, offer diversification benefits and inflation protection. The right allocation isn't the same for everyone. It depends on three variables: time horizon, risk tolerance, and financial goals. These three variables interact in ways most people don't fully consider, and getting them wrong is the most expensive mistake in investing. Time horizon is the most important variable. If you're 25 and investing for retirement at 65, you have a 40-year time horizon. In 40 years, every major market crash in history has been followed by a full recovery and new highs. Short-term volatility over that horizon is irrelevant. The risk isn't that the market drops, it's that you're not in it long enough to capture the full return. A 25-year-old with a 40-year horizon should be almost entirely in equities. The cost of excessive caution at 25, holding 40% bonds when you could hold 90% equities, compounds over decades into a dramatically lower final portfolio value. Conversely, a 60-year-old approaching retirement has a different problem. A 40% market crash the year before they retire isn't a temporary drawdown. It's a permanent reduction in the income their portfolio can generate. Sequence of returns risk becomes real. Protecting capital matters more. A higher bond allocation isn't timidity, it's rational risk management for a different time horizon. The classic frameworks, the oldest rule of thumb: your bond allocation should equal your age. At 30, hold 30% bonds. At 60, hold 60% bonds. Simple, memorable, and too conservative for most modern investors because it was designed when life expectancy was shorter and bond yields were higher. A more modern version: subtract your age from 110 or 120 to get your equity allocation. At 30, that's 80 to 90% equities. At 60, 50 to 60% equities. Better, but still a simplification. The more sophisticated approach recognizes that risk tolerance is psychological as much as mathematical. A portfolio that's theoretically optimal but causes you to panic. Sell during a correction is worse than a suboptimal portfolio you actually hold through the crash. The right allocation is the most aggressive one you can hold without losing sleep and without selling when markets drop 30%. The rebalancing problem. Asset allocation isn't a one-time decision. Markets move. A portfolio that starts 80% equities and 20% bonds will drift as equities outperform bonds over time. Without rebalancing, you end up with a very different risk profile than you intended, usually more aggressive than planned, because equities tend to outperform bonds over long periods. Annual or semi-annual rebalancing, selling what's grown above target and buying what's fallen below, keeps the portfolio aligned with the original intention and forces a systematic buy low, sell high discipline. The single biggest mistake. The most common allocation error isn't being too aggressive or too conservative. It's having no allocation strategy at all, buying whatever seems attractive at the moment, accumulating positions without a coherent framework, and ending up with a portfolio that doesn't reflect any intentional decision. A portfolio built by impulse is almost always poorly diversified, poorly aligned with the investor's actual time horizon, and impossible to rebalance because there's no target to rebalance toward. Start with the allocation. Everything else follows from it. The specific funds you choose matter far less than getting the equity to bond ratio right for your situation and having the discipline to hold it through the inevitable volatility that comes with being invested in real markets.